Hey, everybody, I'm Doug Shoemaker with the Shoemaker Loan Team at Homestead Financial Mortgage, and welcome back to 1 Minute Monday. Each week, I'm going to do my best to take the top mortgage and housing news and deliver it in around a minute for my friends that just want to know what time it is. Then, for my friends that like to know how the clock works, I'm going to dive a little bit deeper so that everybody gets the information that they need the way they consume it best. So, let's go ahead and get started for my friends that like the short version. Inflation cooled a little bit more than expected. The delayed consumer price index, or CPI data, showed that prices rose only 0.2% over the last couple months, and inflation's actually now running at about 2.7% year over year. Now, core inflation, it fell to about 2.6%. That's the lowest level we've seen since 2021. And the labor market continues to soften. The unemployment rate, it's actually climbed to 4.6%. And that's the highest level we've seen in about 4 years. And broader measures actually show that more people are stuck in part time or underemployed roles. Now, housing showed some modest improvements. Existing home sales rose again, and it was the third straight month of gains, while inventory dipped seasonally to about 1.43 million homes. For mortgage rates, based on national averages from Mortgage News Daily, the 30-year fixed rate is around 6.24%. The 15-year fixed rate is about 5.74. The 30-year FHA 5.87 and the 30-year VA 5.89. Now these are national averages. Your personal rate may be higher or lower depending on a whole lot of different factors. I am more than glad to help you figure that out. It's a lot easier than you would think. Now for rate lock guidance, we're going to start this week floating both inside and beyond 15 days, but make sure you stay nimble. Make sure you check out the Shoemaker Loan Team on Facebook page. If there are any alerts to lock, I'll post them there. And that's it for everybody who just wants to know what time it is. Now, let's go ahead and slow it down a little bit and walk through what actually happened last week and why it matters. We finally got a batch of delayed government data, and almost all of it pointed in the same direction. Inflation's easing, and the labor market's actually weakening. Now, on the inflation side, the big takeaway wasn't that inflation came in lower than expected, it's that both headline and core inflation surprised to the downside and at the same time. Now, shelter costs are still elevated, but even with that drag, inflation cooled more than forecasts anticipated. And that's really important because it shows inflation pressures are continuing to fade without the economy having to fall off a cliff. Now, on the other side, the data continues to deteriorate. Payrolls are revised lower, unemployment is actually trending higher, and the composition of jobs is shifting away from full time toward part time positions. Now, jobless claims also suggest that people are taking longer to find new employment, and this puts the Federal Reserve in a really difficult spot. High inflation limits their ability to cut rates, and a weakening labor market actually increases pressure to ease those rates. Now, the Fed, they've already cut rates 3 times this fall, and while the Fed funds rate doesn't directly control mortgage rates, it absolutely influences the overall rate environment. Now, Fed Chair Powell has said there's no risk free path forward, and that's exactly what we're starting to see play out. Housing data was mixed, but slightly constructive. Existing home sales rose again, inventory declined seasonally, and builder confidence ticked higher, though it kind of remains well below expansion levels. Now, buyers are still cautious, though. Affordability remains tight, but demand hasn't disappeared. Now, from a market perspective, mortgage bonds are trading in kind of a wide range. We're holding key support levels for now, but we just haven't broken through any decisively higher levels yet. Now, with a holiday shortened week and light trading volume, volatility can show up in either direction, but we're going to go ahead and start the week floating both within and beyond 15 days. Now, for my friends that really like to know how to build the clock, let's dig into this week's deep dive topic, which is why shelter inflation lags reality and why that matters so much for mortgage rates. See, shelter inflation, it's actually one of the most misunderstood parts of the CPI report. Housing makes up roughly a third of headline inflation and nearly half of core inflation. Now, because of the heavy weighting, shelter can keep inflation elevated even when almost everything else is cooling. But here's kind of the key: shelter inflation is not measured in real time. The CPI doesn't track current home prices or asking rents. Instead, it relies on surveys and averages that reflect housing decisions that people made months ago and sometimes even a year ago. Now, leases roll in slowly, and owner equivalent rent updates, those come in slowly also, and that means that shelter inflation is always late to the party. Now, we saw rents peak well over a year ago. Home price growth has slowed pretty dramatically, In many markets, concessions are even back again, but CPI shelter data is only now starting to reflect those changes. That's why shelter inflation often looks pretty sticky, even when housing costs on the ground are cooling. Now, this week's report showed that even with shelter still elevated, inflation came in well below expectations, and that's a big deal. As shelter continues to roll over in future reports, it actually creates kind of a built in tailwind for lower inflation readings without requiring a recession. Now, this is one of the reasons that the bond market has remained pretty calm despite some pretty noisy headlines lately. Now, bonds don't need perfect news. They just need confirmation that inflation's trending lower and that the labor market's starting to cool. When you combine lagging shelter inflation finally catching up with a weakening job market, you get a setup where the Fed eventually has to lean towards easing policy further, whether they want to or not. Now, that doesn't mean that mortgage rates are going to drop in a straight line, but it does mean that the long term pressure is not for rates to spike meaningfully higher unless inflation reaccelerates. And right now, the data just doesn't support that. That's why we're starting this week floating. So here's the big takeaway for the week: inflation's cooling, especially when you understand shelter lag. The labor market's weaker than headlines suggest, and housing is stabilizing, not collapsing. Hey, everybody, if you're buying, refinancing, or planning for next year, this is why context matters more than headlines. If this helped you, please like, subscribe, and share it with somebody who might need it. I'm Doug Shoemaker with the Shoemaker Loan Team at Homestead Financial Mortgage. Happy holidays, everybody, and I hope to see you soon.